So, welcome to a special episode of the Crypto Bullseye Show, the making of the Crypto Tax Blueprint, Part 2. I'm Kirk David Phillips, and I chat with Dr. Stephanie Murphy, who, of course, is the former Let's Talk Bitcoin podcast host and a voice actor who brought my book to life, and she did an amazing job doing so. So if you didn't catch Part 1, please listen back to Part 1, which is in the show note description. In the meantime, let's pick it up for Part 2. So you should know also that I'm actually aligned with you on the homesteading thing.
Oh, yeah?
I don't know if I've actually used that word, but I've actually been looking for ranch land. Like for actually years. I haven't been as hot and heavy on it right now, but like this goes back probably 3-4 years looking for kind of like the Midwest, just because there's more space there. You'll typically see chunks of land in the 35 acre. For some reason, there's a thing about 35 acres. I mean, you could see them less, but that's because people have subsequently split them up. But there must have been something about the rules or the regulations when things were first carved up. And
is this like the 40 acres and a mule kind of thing?
Yeah, right. But even in multiple states, you still seem to see that 35 acre sweet spot for pretty cheap relative, because I'm on the East Coast, and I mean, it's like land's expensive, but you can get a nice chunk out there. So I was really focused on, I just wanted to secure the land. Mm-hmm. Let's say while the getting's good, like in the movie, I don't know what movie it is, but buy land, son. Gotta keep making any more of it, you know? So
yeah, they're not making any more of it. Yeah.
Asset, land is also a scarce asset. Bitcoin is scarce, but you know, so basically what I think that we've got it all wrong, because of the way I see it is, you know, suburbia, keep up with the Joneses. It's about, oh, look, there's a developer that got some, I'm seeing these developers build on these pieces of land. They're like, that's the most undesirable piece of land, you know, based on what's around it. It's like, it's not just about the fact that you develop this little pocket or whatever, but like, look what's around it is like lame. And it's like, they build them and the people come and they put whatever price tag on it and it gets sold. But the thing is, it's like, they're building it. Sometimes I'm like, okay, so when it comes time to make the repairs, you can't even get a scaffolding in between the houses because they're so close together. And they maybe even gone and gotten a, what do you call it? A zoning exception to be able to, you know, expand and make, you know, maybe build a bigger house than you normally could based on the, so they're like trying to make as big a house as possible on a little land as possible. So my point is, I think everybody's got it backwards. It's like big house on tiny land. I think it's like tiny house, big land. And I love the tiny house movement too. I'm like, really,
yeah,
you know, I really like the tiny house thing. So I'm really drawn to that as well. But it was also about, you know, wanting to grow my own food. That's all part of the whole mix as well. So
that's so cool to hear about that. Well, maybe we'll have to check back in and do another podcast about homesteading stuff, because wow, like I have learned so much over the last couple of years about this. And I went from like, you know, I was always interested in gardening and like, you know, I had houseplants and stuff, but I lived in a condo before this. And, you know, it was a huge, like the learning curve was just going like this, you know, learning about actually growing stuff that you can eat, and just also learning, like seeing the results. Like it is so different to eat something that you made, you know, that you grew, or not that you made, but like that you nurtured and grew. And this is, it made me feel really connected to nature, to like, you know, all of our ancestors who's been doing this for thousands and thousands of years. And so, yeah, I don't want to get too like,
well, let food be thy medicine and medicine be thy food. You know, I mean, you think about it, like if you fill up the cart, if you think about it, it's like, oh, wow, how much of that stuff is processed and in boxes? And a lot of time it's like most of it. And the whole, like the natural part, if you'd even call it that, meaning like, is it organic or how many chemicals do they use? That's another story. But, you know, if you just look at what's green, forget about how it was grown, that's like a little piece of the cart. It might even be the little thing in the front, like, you know, that little raised piece in the front of the cart. That's where you put the greens so they don't get crushed, and the rest of the stuff in the big part, that's all where the boxes and the frozen stuff goes, you know, where it's all processed. So
yeah.
So,
and I,
you know,
I have to say, like, just one more thing about this, like, we're not saying that any of this is easy, like to be your own bank or to be your own grocery store, like two totally different things, although they're related, but they both have like lots of challenges. it's not easy, but it's worth it, I think. Like once you experience that feeling of, sort of taking that responsibility, it's really, really cool. And I don't know about you, Kirk, but like I guess I've always been interested in like do it yourself, like kind of this DIY thing. I used to be really into like punk rock and like
Hmm.
everyone had these like things on their guitar cases that says DIY or die. And I'm like, yeah, like that. I really understand what that means now.
Oh,
It's
interesting.
like,
Yeah.
it's like
Well,
if,
yeah, I think, I think now that I never really thought about it like this before, but I would say that I kind of have the DIY like DNA from my dad, because my dad always thought it was important to learn as many skills as possible.
Mhm.
And he'd always be like, and that's what he did. And he would pass it on. I was like, you got to learn this and got to learn that. And now to some degree that can backfire, but I don't want to go down that path. But it is good to be self-sufficient. Like us, talking about the woodworking.
Mhm.
So when my dad taught me skills around, now some of these things I went and learned on my own as well, but like he taught me electrical, plumbing, a lot of these. And also in
Oh
the
wow,
process of
yeah.
that, I kind of learned and added to my skills toolbox. So like, the drywall, the painting, the trim carpentry, some framing, but electrical and plumbing, and just like, you know, so all those things are like highly valuable. And like if you really,
Yeah.
especially if you consider the headache that if you can actually go find somebody who's reliable, who
Hmm.
will actually show up, who won't take your money if you're trying
Hmm.
to get home repairs and do all that, all of a sudden you realize how valuable those skills are. And so I'm like so thankful and grateful for my dad. You know, the last thing he
Totally.
gave me before he died, he passed away in 18, about 5 years ago. Last thing he gave me was he handed me this book, which is the HVAC training book. There's only a couple of folks that actually do the training, and it's you got to go take this test because you can't buy the much of the refrigerant now unless you have this license.
Hmm.
Right. And again, he taught himself all this stuff. And actually once you get it, you got it. There's no like additional education or anything like that. But anyway, he gave me the book. He said, here, go do this. And you know, and so because I wanted to honor my dad's request, and I went and did that. And and that's a whole nother
Wow.
world unto itself. That stuff is complicated. If you don't use it all the time, it's really hard to kind of jump in there on that one, because it's like I said, it's that challenged me a lot. But anyway, I'm saying, yeah. So back to the homesteading thing, what I think about now that you're talking about self-sufficiency and it's not easy and stuff. Yeah, we're definitely not saying it's easy, but
Hmm.
nothing's easy. But then again, once you dive into it, it can become easy when you expand your skills and you just do rinse repeat and go through the process no matter what it is you're doing. But I was thinking about this recently, how now you're saying homesteading, but I'm going to call it like it's the farm, just to
Hmm.
use the farm metaphor. So I actually think that crypto is a lot like farming.
Hmm.
Okay, and the reason I'm saying that is because I've been talking to this one friend of mine. It's always like a mastermind call. We've been talking for like 8 or 9 years once a week.
Hmm.
It started randomly from this one thing, and we talk like once a week, right? So he goes, oh, I was talking to my daughter last week, and I was telling her that you're into crypto, and then I was trying to explain to her what it is you do, and he's like, honestly, I really don't know what you do. And we talk every week. I mean, this is almost my whole crypto journey. He couldn't, and I was like, okay, well, I mean, sometimes we don't dive into it that deep because we're talking about a whole life stuff. But I was trying to articulate for him what it is I do. And I was like, you know what? I said, tending to crypto is a lot like tending to a farm. Because if you think about the farmer, and you could probably relate to this more, but again, I've never actually like really lived or worked on a farm, but I know I do come from farm country. I'll put it that way. So I know it from that way. So, every day on the farm, there's something to do. You're never without something to there's something to tend to. It's like sunrise, sunset all year long. Got to fix the barbed wire fence, got to, fix the tractor tire, got to do this, got to do that. I mean, there's an endless list of stuff. And I think farmers love it. It's like in their, it's like in their makeup, and
I don't
they
know
just
if they
love that
always
stuff.
love it, but
Well, yeah,
but
it
it's
could
true.
be.
It really can be like that. There's always like a project to do or something to fix, but part of it is also like picking what is the highest priority. Like that's something I sometimes have trouble with. I'm like, I get really ambitious and I'm like, oh, I'm going to do everything, but then I end up having to say, okay, like I need to plant the potatoes now because like they need to get started or whatever. And then I'll do the fence because they're not going to sprout for another couple weeks, whatever, something like that. Um, so
That's it. Yeah,
so
you're
it's
right. That's exactly it. But I think I can't think of actually a better metaphor than which is interesting because we call a lot of things in crypto farming, like,
mhm, yeah.
farming
The
for
only difference
rewards.
is that the crypto doesn't rot over time, like if you're storing it or whatever. Like you can't put corn or something in cold storage and have it last for decades and forever, but with crypto, it actually becomes well, not that it's nothing is guaranteed, but like so far it's kind of like becoming more valuable over time.
Yeah, well, there's like you said, yeah, yeah. I mean, especially from like when I'm talking about like the DeFi perspective, like that type of stuff. Because if you're really involved in the nooks and crannies, that's where the farm metaphor really comes
Hmm.
into play. As far as like, yeah, what I wake up today, oh, what's the priority? Like you're talking about, what do I need to go tend to today? But there's always something to tend to. Like right now, I can think of all kinds of stuff. I'm like, oh, I'm behind on that. I'm behind on this. And so what behind means, oh, those assets are not being optimized. So it's the same as saying, oh shit, that's right. I should have planted that field last week, like 2 weeks ago,
Yeah.
but I can't do that because I got the engine on the tractor that I need to do that with is in repair, and then the blah 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 and everything. So it's kind of like
Yeah.
that.
And it like I feel like this is supposed to be kind of like passive income, or like some people talk about it that way, but it can end up being really active if you're like, if you're putting in the time to like manage it really actively. And so for me, like one of the things I've been trying to figure out with farming and with like everything else in life is like, how can I make it simple enough that I'm not going to go crazy and I'm still going to get a decent return or a decent yield, but I'm not going to be spending like all my time like squeezing that last 10% out of it or something like that. If I
Interesting.
can
Yeah.
be if I can be lazy and I can just like kind of drop like compost on top of the soil and then put a little more dirt on top of that instead of like digging two shovel things deep and mixing it all together, like, which is a lot more manual labor. Like maybe I'll do the lasagna compost method instead because that's easier.
Hmm.
So yeah, like that was one of the things I'm experimenting with right now is like there's different methods of growing potatoes. Like one is like you dig in the ground and you put them in and amend the soil or whatever, and then as they start to grow you hill them up, so you like add more dirt and like kind of
Hmm.
gather it and put it around the vines as they're growing, because that will cover the new potatoes that are forming and let them grow underground, which is like where you want them to be. But then there's also this no dig method where you kind of just scratch up the surface and you put the potatoes on top, and then you put like a pile of decaying leaves and dirt on top.
Hmm.
And some people really swear by that it's like it's super easy. You can even put just like straw on top and they'll apparently grow in that. And I've never tried it before, so I tried it this year. I tried two different, like both of those methods for planting potatoes, and I'm going to see how it works out. But if I can save some work and still get like a decent yield on the no dig potatoes, maybe I'll just go with that in the future because it's so much easier and it saves so much time.
Wow, who knew we were going to go from crypto taxes to all the way to potatoes?
Well, it's a metaphor too, because it's like maybe you don't have to get it perfect, but if it's like 90% perfect, then that might be good enough. I don't know. With DeFi or with like with the data like that you were talking about, like sometimes you can't solve every single little error, and maybe the error is immaterial, right? Maybe it doesn't make like, that much of a difference or whatever. And so as
Yeah.
long as as long as you as long as you know that it's not going to make that much of a difference, or it's sort of isolated to like one wallet and the overall landscape of that wallet, maybe you don't have to spend hours figuring it out because it's not going to make a difference anyway.
That's an excellent point. That's really spot on. Yeah, because you're right about how that's really what it comes down to. A lot of times it's materiality. Because if you got something that's not material, the question is what's material for you.
Yeah.
So what's material for Bob may not be material for Alice, and so on. But the question is it material? And if it's not, then it's just like, again, you could go with the conservative method. Say you like, I have no idea what the cost basis is on that. We're talking about something that's, let's just say $200, or maybe for Alice, it's 1,000, but that's not material for her. Like, we'll just make it a zero cost basis or whatever and do no work. It's, you got to
Mhm.
look at it's the cost benefit of how much work is it going to take to get, the perfect, to actually solve it completely. Now,
Exactly.
sometimes you may, I mean, so, oh, look, I just had speaking of that, I got a stink bug was crawling up my neck. So
Ah!
somehow they infiltrate this time of year. I don't know how they get in here, but in my loft, the tower they get up here.
They
I don't know
like
where
it
they
up in
come
the
from.
tower,
So yeah, so
stinking up the
material,
tower.
that's really an important one. If it's material, then you really need to dig in and figure out how to try to solve it. But if it's not, sometimes you may say it's, material, and like I'm giving an example where you then find out like you spin wheels and you just didn't get any further than you were from when you started, and then you're no further along. So that would be a situation that might not work out too well, but hopefully the more work you put into it, you can come up with a solution. So
Mhm.
documenting is super important. Like, I've actually made like what are essentially like personal guides, like with screenshots on DeFi stuff,
Mhm.
and they've turned out to be, pay dividends, because it's like, actually, because it actually doesn't take long to forget. You could have some of this stuff could start to fade away, and you're like got multiple things you're doing, and also, it's a guide, but in some screens you may lose it. That's another thing too. Like, in the moment that you're there, if you don't capture it, you may never be able to go back there again on a
Yeah.
particular, like a DeFi platform, whatever it is. But like, I've made guides that, like, I just did one where it's been a year for this thing that you had to lock up some stuff. There was like a year lockup. I was like, oh, I knew that year had expired, and I went back to it, and I was like following my guide, and I'm still like, oh, like, and then I could see like what I would say it wasn't like perfect. It was like it gave me enough, but I was like, oh, I could have done this and I could have added that to it, and I could have, so you realize where you can get better all the time. But yeah, materiality is definitely a big thing for figuring out where to
Yeah,
go,
but to
how
be
much
able
work to
to
put
make that
into it.
judgment, about how you like basically how much work you want to put in to like make it perfect, and do you even need to do that? You need to be familiar with the whole landscape and the whole concept of how would you do this if you did it perfectly, right? And then you can decide if you want to go all the way to perfect, or if you want to get just like good enough, or like prioritize the most important things. And that's what your book lays out. It's like a whole landscape of like, okay, this is like the gold standard of how you do this. And then, I expect that, a lot of people are gonna read this and do most of the things, but they, maybe they don't want to go to 100% perfect, but they can, and they know how to, and they know what they really need to do, what's the highest priority, from being familiar with the whole landscape.
That's right. Well, that makes me think of Bruce Lee. One of his favorite quotes was, you know, he says, talking about just taking information in general, right? So it's like, take what you want, discard what you don't want, make the rest your own.
Mm,
So in other
I like
words,
that.
take what you want is take it exactly as it is. And if you don't want something, just discard it, and the rest customize it to your own self, however you want to do that. I always thought that was a great saying. So
Yeah.
that's really what you can apply here. So another thing here is, I think it would be important to say is that there's the section I call it the balance check
Mhm.
chapter, and I talk about the accounting equation. So, which is A equals L plus E, which is like super dirt simple. I love it. You can't have really a more simple equation. And that's just assets equals liabilities plus equity.
Mhm.
So, and all that is I think of it like a set of old fashioned scales, is my analogy. Actually, you know what? I think I came up with this at that talk. Speaking of that blockchain conference, I think I might have
Yeah,
talked about
I
this too.
remember it.
But it's really a set of old fashioned scales like in the 1800s, and you go get the nails or the whatever you're getting, and you put those on one side of the scale, because my grandmother had one of these, right? And then you put the little weights on the other side, and you balance it out, and okay, that's this much weight, and then we know, well, that's how much to charge, and that kind of thing. So that's really what accounting is. It's like you're always in balance. There's always a mirror image of every transaction. So, like if you were to have let's say you started a business completely from scratch, from zero, no transactions have happened yet. The first transaction is, oh, I'm going to contribute $500 to this new company, LLC, or whatever it is. What's the company have now? It's got $500 in cash, but then what's the other side of the scale? It's got to be something. So did you own the money or did you borrow the money? So if it was your own money, then that's equity. It's 500 in cash and 500 in equity. But if you went to the bank and borrowed it, then it's still $500 in cash, but now it's a $500 liability. Everything is always in balance. So, and I'm saying that that's an important thing to take away here. And kind of one of the reasons I'm bringing that up is because there's a distinction between a lot of the crypto tax software really falls into two buckets, which is there's a retail product and then there's a business product. And in the early days, really most of the products started as retail products. They were never designed for business. Now we have a short list of some software providers that are coming out that are focused on the enterprise, where you can actually connect it up to legacy accounting systems and so on like that. And because the crypto accounting for a business is 5 or 10 times more complex. I mean, it already is anyway, business and the legacy business versus individual, but now it's even more extreme like that. So the retail product is not designed to be an accounting system. And my definition of accounting, some people say, oh, it's accounting, it's an accounting platform. No, it's not. Accounting platform is not an accounting platform unless it's fully designed to be full-blown income statement, balance sheet, etc. If it doesn't do that, it's not really an accounting system. It may do some elements of accounting and stuff like that. So what I'm saying is a lot of these, they will give you a dashboard and they'll calculate the taxes, but they're doing a one-off piece. And so when you don't have the full, let's say the life cycle of that, and I'm saying if you don't have that, you're not following the accounting equation. And so when that accounting equation is, it's basically a mathematical proof that your stuff is accurate. I actually didn't think about this after all these years in accounting. I didn't think about this until writing this book, that that's actually what it is. Because we talk about proofs in blockchain and, zero knowledge proofs and all that kind of stuff. We talk about proofs, mathematical proofs. That's what that equation is. It's a mathematical proof that what you're representing happening is actually accurate and complete. So it's difficult to have that when, like a retail product, for example, is not a full-blown accounting system. So we'll give you a balance, but the issue is, what I wanted to point out here is that you may go through the process and say, wow, my calculations look right. I followed a lot of these golden nuggets and, I think everything looks good. But then if you were to go look at the balances and cross-check what the dashboard says you have in ETH and Bitcoin and every other coin you have, and you went and actually referenced it, right? And you looked at what you actually have in total, and that stuff's way off, that means something's wrong.
Yeah.
So you may think your calculation was correct, but then on the balance, so that's why I'm saying this is all tied together to that equation. And so if the balance is wrong, then you got more troubleshooting to do. You got to go figure it out. But that's the one thing that's the beauty of a full-blown accounting system. Every transaction is actually those scales, which is like a journal entry. Every time you do a single transaction, it's always in balance, which means it's always in balance. The balance sheet is in balance. Everything's in balance. Everything's correct. All right.
Yeah. And you you go through some examples in the book of like, well, what if it's close, but it's not exactly balanced? And you show examples of how if it's not exactly balanced, like that could be deceptively actually like a big problem, because there could be like errors in different directions that are kind of balancing each other out.
That's right. Yes. Well, just to tie into this too. So the thing is that, a lot of software will give you these warnings. And a lot of times they're like negative balance warnings. That's pretty universal. It'll give you some type of warnings like, oh, hey, now there may be different terms used, warnings / errors or whatever, but nonetheless, it's that. So the point here, you could go through the whole exercise and actually not see any warnings at all. Or you could have warnings and solve it. Okay. And then you say, cool, look, it's right there. It says it's warning free. That means it's perfect. My point is, you could have a whole bunch of issues buried that actually don't come up. So just because there's no errors in the software doesn't mean you got a perfect free pass. Everything is actually accurate and complete. So you just happen to, if there is a warning, the point is you got lucky that it actually created a warning to give you something to go look for. But you could actually have issues buried in there and never know it. So if you're just relying on the software says no warnings, that doesn't mean you don't have them buried somewhere. So stuff can be buried in there. But The other thing too is, as far as the things being in imbalance, I could go, we could hang up in an hour. I could, go create $1 billion fictitious company. I wouldn't do that, but like you could just do it for journal entries. You could just make it up. Journal entry, journal entry, journal entry. Here's a balance sheet. Here's an income statement. Wow, that's amazing. It's all in balance. It's perfectly in balance, but that doesn't mean it's accurate, because you got to verify and you also got to reconcile. That's the problem with this stuff, is it's the reconciliation conundrum, which that's a whole nother thing, go into the weeds on. It's actually interesting. It's extremely challenging to reconcile with this. And I don't want to go too far into the weeds, but the other thing that I find is people use the word reconcile in different ways. And
How do they use it in different ways?
Actually don't really understand what reconcile actually means, but it means I have what I have here, and I'm trying to cross-reference it with something. I'm trying to triangulate to make sure it's correct. In the legacy world, that means I got this, the bank says that. That's actually the one thing I'll give the banking, by the way. One of the few things is that they actually give you a statement, and you're saying that that's gospel. So as long as we both match, I'm good. But you can't really do that in crypto.
Well, another thing is, like, in a legacy bank, like, you can overdraw your account, right? And sometimes, especially if you have like a backup account that's linked to it, it'll pull it from that backup account, or like a slush fund, I guess you could say. But with Bitcoin or crypto, you can't do that. Like, you can't overdraw your account. And so if you have some kind of software like that is helping you with your accounting and it shows a negative balance, that's an error. That's not real, because you can't actually have a negative balance in a crypto wallet.
Yes, that's a good point. Yeah, you can obviously have that. You can have negative balance in legacy, but you cannot have it in crypto. That's kind of the marrow of it. One of the pieces of the marrow of crypto. Yes, you cannot go negative. So, which is interesting, because also with fractional reserve, fractional lending with the banks, I mean, I think some people are maybe coming up with stuff, but essentially crypto doesn't have that either, which by theory means you can't really have a bank run. But it's interesting, because what I've heard is that these FDIC reports on some of these banks is that there was really poor management and poor risk management and stuff like that lurking for a long time. But nonetheless, even with that said, what I noticed is it's the same thing as people asking, like, how does Bitcoin value? How does anything have value? And to me, and this is after studying economics and the stuff you talked about on Let's Talk Bitcoin, and a lot of the things I never thought about until getting into crypto in the very early days. And then I started to question all these things. To me, what it comes down to, it's dirt simple, is nothing really has intrinsic value. It's anything has value because there's a group of people that agree that it has value, and it's as dirt simple as that. So if people start freaking out on a bank and they lose confidence and start drawing the money out, it's done. Even if they manage risk to the highest degree and they got the A+ higher than any other bank, people start losing confidence, that bank is done. People are going to start drawing that money out. And because I heard stories,
and that goes for currencies too, right?
Yeah.
Like whole currencies, like, for example, the US dollar.
Yeah. So, but like we got a ways to communicate with social media now. They create in real time. So I was hearing stories about like Silicon Valley Bank, like, because they're catering to a lot of startup founders, and they'd be like on their chat channels or whatever, like, hey, like one founder would message another founder, hey, blah, 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 blah. And then they panic, and then it just escalates, and everybody just pulls the money out.
Wow. That's interesting.
I guess what I'm saying is fractional reserve lending to me is inherently flawed, because I think this could happen to any bank. Even if they manage themselves really well, I think there could be a bank run.
Yeah. And it definitely happens to crypto bank like institutions or whatever. Like, anyone who's custodying crypto on behalf of their customers, they can be dishonest about their balance sheet, or they can be insolvent, and most of the customers won't find out until they're unable to access their funds. So that can definitely happen. And it has happened so many times.
Yes, absolutely.
The only place that can't happen is if you self-custody. So just be aware of that.
That's right. Yep. So love self-custody. Oh, one other thing that would be important to point out, and I'd love to hear any final thoughts about other stuff that you got out that thought that that you processed from doing the audiobook. But one thing I wanted to point out here that I think is a major issue. I actually did an opinion piece on CoinDesk a couple weeks ago on this as well, but it came from me putting this in the book in one of the later chapters. I don't know if it's the balance check chapter or whatever that was, but one of the late, like eight or nine. But this has to do with the new 6045 broker reporting regulations that are coming out. Okay, so this is not new in the sense that this came out as part of the Infrastructure Act in the US, but now it's a matter of when are they going to be implemented and that kind of thing. So this is also relevant, by the way, as I see it, to any tax regime that would do a similar thing. This is not, even though it's happening in the US right now. So
yeah, and that's right. And the book applies to, the book is kind of meant to be jurisdiction neutral. Like this is like general concepts, and you do mention like, okay, this is what the US does, but like this can apply to other tax regimes, just like, know the rules or whatever.
Yes, that's right. This is kind of parallel to the relegation zone thing, but somewhat of a similar concept in the sense that you're relegated to managing the data yourself, whether you like it or not. That's just how the game is. But similarly, most of the work is actually done in corralling these transactions, right? It's the software, it's the data formatting, the quality of the data, you as a taxpayer, how you organize. It's actually assembling it all together and getting it in the right buckets. So like that, I mean, again, what's the percentage of that? I don't know. I'm saying like 90 or 95% of the work is just getting to that point. It's the last mile where you apply the tax rate to it. So for example, the ultimate prize, the ultimate end game for the US taxpayer, and again, could be similar for other jurisdictions, but it's to get this 8949, the tax form, spit out from the software. That's what your goal is. Then you take that and you upload it, or you make an attachment to it in your tax return. But you're basically picking up 4 numbers, which is the proceeds minus the cost basis, which is where you figure out the gain or loss from. And then it's that for short term, and then that again for long term. So it's 4 numbers. You pick those numbers up, you put that in the tax return. The actual legacy tax return software calculates the tax. But you had to do all that work to figure out to get to that point in the first place. And that's the same thing over again for DeFi. And there's still a bunch of stuff we don't know. And it's going to take years to shake out as to what is actual the tax treatment here. Not just in the US, but other places. It's just, there's a lag. There's a typical lag between there's something new and when do you get clarity about it.
Like, for example, what would be an example of that?
Well, great example is crypto losses. So I've been fortunate to be involved with the AICPA's virtual currency task force since 2018. And this is basically like, there's many working groups where they're in AICPA, it's the largest trade group for basically certified accountants in the world. Okay. So, there'll be like a staff person, like a paid employee staff that might run these things, but a lot of working groups are like volunteer professionals that just volunteer their time to contribute. That's what this is. Think of it as a pay it forward group, right? And the main purpose here is to identify what the issues are, articulate them, send them to the IRS and say, hey, we need clarity, or we need new rules. We need actually not just clarity, but in some cases, this is a new thing, how to treat it. Or we might say, this is how we think it should be treated. All right. So been doing that for a long time. So there's one that we just came out that got published actually in April, which is called How to Deal with Crypto Losses. And again, if you look at it, this is an 18-page, and this, by the way, is one of the things you would get in supplemental material. So as these things come out and once you get connected, we would continue to provide these type of things, which is great intel, because this is coming from, it's probably the best intel you can get, really. And we're talking about, you don't have any real published guidance yet necessarily, but it's like, what are the tax professionals thinking? So that might be the next best thing you got. But anyway, so this is an 18-page thing just on losses. And when you read that, like, it'll just blow your mind apart.
Losses like when a custodian goes under, or losses like you lost money. Okay.
Correct. All that. Yeah. Sorry. Yeah. Okay. So that's what I got to get to, right? So it's not crypto losses from a trade where you're in the red.
Right.
because
It's
those are the
losses
obvious
when
loss. I'm talking
someone
about,
else loses your
yeah,
coins, right?
exactly. All the other kinds of losses besides that type of loss. That's the obvious loss. But the point is, most people probably think, oh, loss is a loss. Every loss is the same, and it's not. It depends what the
Right.
facts and circumstances are. Is it in this bucket, that bucket, or that bucket for losses? So
Yeah, I
basically
mean,
you've
and
got,
that's very relevant, right? Because it's like there were a lot of exchanges and custodians of different kinds that went under in the last year and over the lifetime of like the whole time that I've been interested in crypto, but especially in the last year, like anyone, anyone who's been involved with the space would probably have some kind of experience with that, and they're wondering like what did they do, like, oh, I had coins in this exchange and then it just suddenly poof, they disappeared. And so how do I can I write that off on my taxes? Is it like I lost my Bitcoin in a boating accident, or is it like someone stole it, or does it matter? Because like I actually looked this up. I actually remember this. Like I was curious about this. Like what is the what are the rules for this? And it's like, well, if you treat it as I understand it, right now the current rules in the US are that if you have lost bitcoins due to a theft, or maybe you could consider like someone else mismanaging the funds, like you could consider it sort of like a theft. um that's not, you can't even deduct that from your taxes, right?
yeah, that's exactly like theft. Theft is one. And then I'll tell you this, you got theft, you got abandonment, and then you've got worthlessness. Those are all,
Right, yeah, okay.
okay. These
Hmm.
are all concepts that already existed in the legacy world, obviously, but now it's like, how do they apply in crypto? So one of the key things is that from the Jobs Act from 2017, that's the one that reduced the corporate income tax rate from 35% to 21%, which is like, wow, that's amazing. This is like once in multiple generations type of, you know, you don't normally like a tax rate. Oh, we reduced taxes. Oh, from 35 to 33. It's like whoop-de-doo. But like when you go from 35 to 21, you're like, woo. But how did you get there? Well, that's because you had to take a whole bunch of other stuff away. That's where people don't talk about that. So to get the benefit here, you had to take it from somewhere else, essentially, which is one of the ways they did that was you can't take itemized deductions from like 2018 to 2025. And like real estate, or actually state tax in general, real estate tax and state taxes are limited to $10,000. So people in high tax states, they got whacked. People in no tax states, it didn't make a difference.
Hmm.
So, so in that case, you can't itemize as well. Things that used to be able to itemize. So what it comes down to is if you have a loss that would otherwise have been an itemized deduction and you can't deduct it, then you've got an orphaned loss, as I call it.
Hmm.
And again, these things are not clear. This is like what we're saying would likely be the case, right? Because we don't have clarity on that. Was the whole point of a comment letter. But for example, worthlessness typically like something and like stocks and again legacy assets, but like something needs to be entirely worthless. First of all, how do you determine if it's entirely worthless? But when it comes to crypto, it's like it could even be worth. Now we got 18 decimal places. You could have something that's
Right.
still, it really doesn't go, it doesn't really end up to be worthless in the true, like let's say IRS stance where it needs to be worthless
And like
now and
another
worthless in the
example.
future. It's never going to have value again. And so it almost means in crypto, nothing can be worthless. But the point, my key takeaway here was, don't take an action to try to prove worthlessness, or don't try to like abandon an asset for an abandonment loss, because if you do, you got no benefit. It's just better to not do anything, hold on to it. As I've learned in crypto after all this time, the one thing I always say is you never know in crypto. I just, 10 years in, you never know. Anything can happen. So it could be that by the time 2025 rolls around, your stuff could be worth something again.
Yeah, that's the thing. And I mean, pretty much like none of this gets resolved within a tax year either, right? It's like there have been exchanges and stuff that have failed, and they'll go into bankruptcy, and then sometimes they'll kind of like someone will buy the debt basically, and they'll issue like a coin that represents the money they're owed to the people who had
Right.
money in that exchange. And then it's like, okay, like it seems like I'm never going to get this money back, but like maybe this will be worth something, but we don't really know. And it's definitely not going to be resolved within a year. And so, yeah, I can imagine people have lots of questions about that on their taxes.
Right. Well, that's what I'm saying. Like just if you just look at losses and like that's an 18-page letter, but if you were to be a fly on the wall during some of these conversations where you hear these really smart people like talking about, oh, what about this? What about that? It would just make your mind would just shatter. It would just go, it would just blow apart. That's what I'm saying. You couldn't possibly write a guide that says the specific, oh, this specific tax piece, like how's staking tax and how's this tax. That would be impossible in the US. And then you're talking about every other jurisdiction around the world. But again, most of the work is not in that. Most of the work is in the corralling of stuff, making sure it's accurate and complete and so on. But just to loop back to the 60-45 conundrum too, because maybe that's a good way to wrap up is, the issue that I see there is, so basically, what does it mean? What do the broker reporting rules mean? What does that mean for crypto? Well, in the legacy world, but that's already been adopted. That's been around for years, decades. And so that's in the US, that's on a 1099B, B standing for broker statement, which means any traditional broker, TD Ameritrade or Scottrade or wherever you do crypto, even Robinhood and so on, any of those, they all issue 1099Bs. And that's just going to have interest and dividends plus any sales of your securities and actually report the gains and losses. So the brokers are already required to report that to the IRS in this case. So there's a lot of third-party reporting, but that's the other thing too, is on your tax return, you can put stuff into two areas, which is, did a third party report on your behalf or are you self-reporting? And a lot of stuff is third party, but not everything's third party because it's the voluntary system, and the stuff that's not third party reported, you got to report yourself. But overall, it's still a voluntary system. And so with 1099Bs, everything is somewhat self-contained, and it's just like, give me the return. Any CPA knows how to deal with it. Now they're not perfect because, you could have had some stock that bounced around through 4 generations and that never got picked up anywhere. So the stuff that's reported is not totally accurate, but compared to crypto, I would say it's like very accurate. Okay. But now we're going to apply this into the crypto world. Okay. So how is that going to be an issue? Well, it's going to be an issue because the way that crypto has worked thus far through the past 13 years or however long it is around crypto taxes is, again, who does the management? You, the taxpayer, does all the management. You do one gigantic universal calculation with everything. And essentially, for the most part, you've taken so if you got, again, you could have dozens to hundreds of wallets. Is not unusual, by the way, as you probably know.
Oh, crypto.
Yeah. Whereas in the legacy world, you may have 2 or 3 bank accounts and a couple of credit cards. But in crypto, stuff can be all over the place. So all that stuff's magnified. But basically, everything gets dumped in one bucket as if you only use Coinbase and that was it. And this is for calculation purposes. I'm just saying, you take all the transactions, throw them in one giant bucket, and do one giant universal calculation. Mm-hmm. But you did it yourself. Okay. And that's
right. But then you get forms. Then you get forms from these companies and they may not be accurate.
Correct. They're not going to be accurate, I think. Right. Now they are recorded. Now one of the reasons that 1099Bs work in general is because not only does the broker report the trades that they executed on your behalf, but if you close that account and say, I'm going from XYZ to ABC, then that broker's got to send that information to the other broker so that the records are accurate. See, so that's going to be applied too. But the issue is with a lot of things, to say crypto doesn't fit in the legacy box, almost across the board, almost in everything or many, many things. So that's going to happen, but you still got issues where you got self-custody is in the mix. So it's only some of the stuff is on the radar. Not all the stuff is on the radar. And so basically you got, in a world where everything is 1099B, let's just say theoretically that works nicely. And in the world of the way crypto has been so far, where you're responsible for all your stuff, one giant universal calculation that you, the taxpayer, do. Now, again, that comes with its own giant set of headaches. All right. But if you do a combination of those two, that's where it turns into an absolute, that's why I call it a monster headache or a monster nightmare. So now you're going to have, if you had 8 exchanges, you got 8 brokers that got their hand in your pot, your calculation pot, and then you got your own calculation. And then it's what they're reporting is that, and I've already seen this before where the reporting that exchanges do is not always accurate. And so now the taxpayer now has to do more work than they did before. They might have to do 2 times as much work or 3 times as much work because now You got to, instead of doing one giant calculation, you got to do little mini calculations and try to just reconcile just Gemini or just Coinbase or just this platform or just that platform, and try to use that, cross-reference that with your software. But the software thus far, again, has a lot of limitations to it. So it's not really designed to even get that granular anyway. So you don't really have the tools available to reconcile. And now you got to do more work, and there's going to be stuff that's going to be reported incorrectly. How are you going to figure out whether it's correct or not? And there's all these other things. I don't even know if I'm explaining it well, but it's like, I just think it's going to be an absolute nightmare.
Well, I thought you did explain it well in the book and just now too, but like in the book. And if anything, like people may read this and they'll be like, okay, I can save myself the headache of dealing with this at all by just avoiding, using those kinds of exchanges that are going to send this form. Or I can, I can choose to be ready for this, right? Like I can keep my own records that are going to match up, and, I can sort of head off the headache at the pass.
That's right. Yeah. This is now about how to be proactive and how to minimize this headache.
Yeah.
And so one example to illustrate where this could really come into play is, what I'm saying is that basically brokers right now, legacy broker stuff. So they will use a FIFO, first in, first out method when they're doing their reporting, but you can send an instruction to the broker to say, hey, I want to use specific identification. So I want to tell you which lot I'm selling when I sell it. And so they say, cool, we got it on notice. And then before they do anything, you tell them what you're selling, and then they sell it, and then they'll use that method. But in crypto, specific identification doesn't work. There's no advance notice of anything anywhere. It doesn't exist. You don't notify, they don't work the way legacy brokers do. When you're using an exchange, you just go on there and do it. They're commingling the funds and, Bitcoin pots and every other coin and so on. And so there's no instructional thing to do. There's no method like that. It doesn't, like, specific identification happens in a kind of a quasi after the fact way. A proxy, as I call it. It's like it's a proxy for spec ID, because you're using software to do it after the fact, where really it's supposed to be before the fact. So in crypto, it happens after the fact. So my point is, because of that, my assertion is, and by the way, these regulations might be out this week. I'm hearing the chatter is, we'll see. So what I'm saying is that most likely the crypto 1099 or 1099 DAs, as they're going to call it, they're going to only report on a FIFO basis. Okay. Well, so how's that a problem? Well, because the software, because it hasn't really been clear, especially in the beginning years, as to what basis to use. So nobody really knew. And right now, again, you can use FIFO, but you can also use spec ID with crypto. But again, spec ID doesn't really work the legacy way. Now, when I say it's a proxy, that means any other method besides FIFO you could say is a proxy for specifically identifying. So your highest in, first outs, your closest cost, first outs, or any of the other stuff. So if a taxpayer has been using that same one for 8 years, in other words, not FIFO, they've been using closest cost, first out for 8 years. Now the broker is going to report on FIFO. You're on another method. You can't reconcile. It's impossible. I mean, you could change the software and say, let me change the software to FIFO and blah, 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 but it's just not going to be, the tooling is not there to get this granular to nail it down with extreme accuracy to sort this stuff out. I'm just not seeing it. And so that's a problem. Now, here's the thing is, again, one of the most important things with cost basis too, while we're on that, because cost basis is a chapter, but
yeah, that's very important, because it really determines like
everything.
Yeah.
Like the single biggest factor in all of your crypto taxes, everything else being considered, is cost basis. So if you were to change the cost basis, the outcome could be dramatic between one basis and another. But one of the key takeaways overall in everything, taxes and otherwise, is be reasonable and consistent in everything you do. That's one principle. When you're talking about materiality, all these other things, how much work do I do, the cost benefit, it's really, it's really that piece. So, so what that means, you don't want to change cost basis, because you got to be reasonable and consistent the whole time. If you've been using it, especially if you used it way back when. Were you consistent? Yes. Was it reasonable? Yes. Because you've been doing the same thing the whole time. So you're not just going to change midstream.
Yeah, but
So
it's
that's
also
why,
hard to pick one and commit to it at the beginning because you don't know which one is going to be the most advantageous for you.
right. Yeah, that's what I'm saying. You also don't have like, you know, you don't have the benefit of hindsight when you start off. You don't have enough data to look at to say which one's more advantageous. But again, with spec, I mean, I've literally heard like attorneys and stuff and even some tax professionals say like, well, how would you do spec ID? It's silly. You know what you would do to pre-identify? Send an email to yourself.
Mhm.
Hey, Kirk, let me send an email from and to the same address. Kirk, I'm going to do this. Like, that's kind of ridiculous.
Mhm.
So that's why, to me, it should be, there needs to be some more clarity on that, because to say that, you know, you can use these other methods, because again, you just can't, specific identification doesn't happen in crypto like it does the old way. So anyway, so these reporting is going to be done on FIFO. I think that's the only way it's going to be done, because it's kind of the only way I see that it can be done. Taxpayer uses another one. How do you cross reference? So again, it's either all 1099, which is probably the way they want it to go. They want to back all taxpayers into a corner so everything gets reported. Maybe it'll end up that way. You know, you know, we'll see how that goes. But
Mhm.
again, when you try to mix the two together, that's where I think that's where the mess comes from. So it's kind of like good luck to everybody sorting this out.
Well, it's you do the best you can. And if you make a mistake, you can probably go back later and correct it. You know, but you just do the best you can at the time. And that's what I took away from it. Like, this is a new thing and it's kind of uncertain. And so, you know, you try to understand it and you try to have reasons and justifications for doing what you do, and you just do your best.
That's right. Yeah. Do your act in good faith, be reasonable and consistent. And I guess, I don't know if we talked about the CYA much, but yeah, cover your ass.
That's
That's
a
the
whole
big thing.
chapter.
Cover your
Yeah.
ass. So if you document and you do all the things, you are covering your ass along the way. That's really what it's about. This is a CYA cover your ass book and a process. Yeah, because, excuse me, when we were in public accounting, that was always like this, the side thing is like, oh, you got your CYA file, which is, you got like the auditing file, which is the real work papers,
Mhm.
but which have to be, you know, it's kind of like, you don't want too much, you want the right thing, but you'd have your CYA file, which is covering your own ass as the person who was doing the work on the side, which aren't really, which were like, call it like informal work papers. So that's where that comes from. Cover your ass. So there you go. I think we've covered it.
Well, I think a lot of people want that, you know, they want to know, like, you know, how can they protect themselves and like kind of document and verify like everything that they've done. And so you definitely show how to do that in the book. And I think that anyone who's concerned and wants that, it wants to know that they're basically like they've got a bulletproof tax return, even though they've used crypto and they've been paying taxes on it and stuff. Like, you show them how to do that.
Great. Well, you know, I really appreciate working with you again. It's been a real pleasure. And hopefully we can do some more stuff together. I'd like to put out some more material on some other topics.
Awesome. Yeah, thanks, Kirk. I learned a lot, like, narrating your audiobooks, both of them that I've done. And you know, I think it's a great, like, digestible, kind of like information packed book that shows you like how to get a handle on something that I think can be really overwhelming for most people, and they don't know where to start. Like, at least individuals, right? Like, maybe it's a little bit different for
Yeah.
businesses. Although you do have like really useful information for businesses too, and for CPAs and other professionals. But like, it's just a great guide. Like, if you feel overwhelmed or you just want like someone to walk you through, like, how do you get a handle on this complicated topic and do the best that you can, you will show them how to do that. And it's not like too long. It's only a 4-hour audiobook. Like, we were talking about the length of of the book, and I think it's really bite-sized. Like, it won't necessarily take one afternoon to do all the work to organize all of your stuff. That depends on your individual situation and what you've been doing with your crypto, right? But you could, if you wanted to, you could listen to this book in like a few sittings, and I think you could digest the information. And it's broken down into 10 modules. And so you could do one module a day, and within a couple weeks you could understand like what you need to do to get organized with this. And yeah, again, it's about like taking responsibility for your finances and stuff. And your book is really helpful for that. So thank you for asking me to narrate it.
Yeah. Well, yeah, this to top that off. Yeah, that's the whole thing. We're talking about the Alice and Bob and Dimitri and all that stuff. But basically, this whole thing is what I would say littered with, what it has is 72 key takeaways, 47 pitfalls to avoid, and 61 examples. So we were talking about the examples, but I guess it's important to point out that to make something that's like this, that's typically like, wow, how do you make something that's kind of fun and interesting and digestible as possible? Well, that's how to do it. It's just like you actually have, so those together is exactly 180 golden nuggets. So I mean, to me, the book, if you just got rid of all the other copy and just focused on these, because they're all like in a box, like in the print form, I mean, that's valuable unto itself. So you got the key takeaways, the pitfalls are, equally as good as the takeaways as far as the golden nuggets, like don't step into quicksand here and stuff like that. And then the examples to reinforce key takeaways and pitfalls. So that's, if you just focused on that, that could be your guide. Just read it and just focus on all those, pitfalls and key takeaways would give you a lot of information there.
Yeah, totally. And the examples really bring it together and crystallize it in a way that you can understand. Because I found that like, as I was reading the examples, I was like, oh, okay, I had like a situation kind of like that too. And I mean, I think they're really relatable, and it helps you understand it so that you can actually take responsibility for being on top of your own finances and your own accounting.
Well, great. I think we've covered it well, and we went, we had a good long session here, and this is good,
Yeah.
good supplemental material for the book. So in a world of where people, competing for, what do you call it, attention, and people wanting like smaller chunks of content, this is a big chunk, but I think it's a really good big chunk of content here today.
Yeah,
So
this
I
is
really
almost
enjoyed the
like half as long
conversation.
as the audiobook, isn't it?
Yeah, that's right. It's a 50% bonus.
Yeah, but hopefully they've figured out like if someone has made it all the way to the end of this video, thanks so much for watching. Now you know what my voice sounds like. And so if you like it, go get the audiobook. And if you've found what we've been talking about valuable, like please go, it's on Amazon, it's on a Kindle version of the book as well as audio. And you can buy the Kindle book, and you can add on the audio book. I think it's like for a reduced price. So it's on Amazon, it's on Audible. Go get it, educate yourself, and take control of your crypto life.
Yes, that's right. So yeah, and then also, yeah, call to action. That's great. And then go below. We'll have the links below so you can see where that is. You can also go to cryptobullseye.zone, and that's where you can also get the supplemental material and other stuff, other golden nuggets, because like we're doing a blog once again where we talk about a lot of these different things, a lot of these tax brain teasers and stuff like that. That's part of like when you get the supplemental material, that'll get you into the blog cycle and all that stuff. So definitely, yeah, go get the book, look at the links below, and you'll be happy you did. So I hope you enjoyed my fireside chat with Dr. Stephanie Murphy on the making of the crypto tax blueprint. So I've seen so many people get tax wrecked over the years, and this is why you want to discover the 72 key takeaways, 47 pitfalls to avoid, and 61 examples so you can cover your ass and keep yourself from stepping into quicksand. So you can't afford not to get the best crypto tax book ever? Do yourself a favor, get your copy today, especially an audiobook, to support Stephanie Murphy, and please smash the like button and subscribe to this channel. We want to continue to keep bringing you great content.